Hello and welcome. You are watching ET Now and I'm Prakash Priyadarshi. Amid global turmoil and tariff-related disruptions, the Indian economy has emerged as a bright spot for the world economy. Second quarter GDP growth has surprised many, cementing India's position as the fastest growing major economy in the world. Reform measures taken by the government in 2025 have played a pivotal role in the current growth trajectory. In this special edition, we bring you a detailed look at the reform measures taken by the government this year.
The year 2025 began with a big bang reform on the direct tax front. In a major relief to the middle class, the government announced sweeping changes in personal income taxation. The finance minister declared zero tax liability on income up to 12 lakh rupees under the new tax regime. For salary taxpayers, this threshold effectively rises to 12.75 lakh rupees with the benefit of a 75,000 rupees standard deduction.
There will be no income tax payable up to income of 12 lakh rupees. Tax rate structures as follows: 0 to 4 lakh rupees nil, 4.8 lakh rupees to 4 to 8 lakh rupees 5%, 8 to 12 lakh rupees 10%, 12 to 16 lakh rupees 15%, 16 to 20 lakh rupees 20%, 20 to 24 lakh rupees 25%, and above 24 lakh rupees 30%.
Following a sweeping overhaul of the direct taxes structure, the government has set the stage for big-ticket reforms in GST. Leading from the front, the Prime Minister made a landmark announcement from the rate fall.
Big bang GST reforms paved the way for a long-awaited rate rationalization. Acting on the centre's proposal, the GST Council approved a simplified two-rate structure, 5% and 18%. A special higher slab of 40% was introduced for sin goods and luxury items.
Common man items such as hair oil, toilet soap bars, shampoos, toothbrushes, toothpaste, bicycles, tableware, kitchenware, and other household articles have all come to 5, whether they were in 18 or whether they were 12. Similarly, reduction of GST from 5% to nil. 5 से 0 में जाने वाले items indicate कर रहा हूँ. Ultra high temperature milk, the UHT milk, chena or paneer, all the Indian breads will see nil rate.
Implementing the reforms effectively was a major challenge for the government. The CBIC, through its extensive informations, ensured that the benefits were passed on to consumers.
The finance minister herself closely monitored the rollout of the new GST structure. During the transition phase, prices of more than 52 essential items were tracked to assess whether businesses were passing on the tax benefits to end consumers, reinforcing the government's focus on compliance and transparency.
Now, I'm joined by Mr. Vivek Johri, former chairman CBIC. Mr. Johri, two-rated structure on the GST have been implemented since you have been at the helm of the CBIC and must have gone through the deliberations. Do you think that the next generation reforms on the GST are moving ahead in the right direction?
Yes, I think it was the direction of the reform was absolutely justified because, as you know, the more the number of rates, the more the chances of evasion and lack of clarity in the rate structure. So it is now well accepted that fewer rates in a tax structure make it easier for compliance as well as for clarity and certainty. So I think what the reform has done is to move in that direction. The next step, of course, and we don't know what time frame that would take, but the next step would be to, if possible, go down to a single rate structure. But generally speaking, it is the view of many commentators and experts that is not perhaps feasible in the context of a developing country like India. So I think a two-rate structure is good enough. There are some anomalies that are created because of a two-rate structure, such as an inversion in rates, etc. Those have been addressed partially, through a quicker refund mechanism, which FM had promised and which has already been implemented now. But I'll talk a little more about what can be done to ease, the pain for businesses with regard to that. As far as the consumer is concerned, of course, it's a very welcome reform. And I think in a large swathe of products, particularly FMCG, there has been a big relief that has been offered to consumers. Automobiles is another example. So yes, from the point of view of taxpayers, it's definitely a relief. For businesses too, it is largely a relief because it has helped boost demand, particularly in the festive season, and it has given a boost to the economy. Therefore, but there are some anomalies that need to be addressed.
Well, some states are still raising concerns about potential revenue loss, though we do not have sufficient data to support that logic barring November month's GST collection. Mr. Johri, my question to you, if collections do not improve, do you think that the state governments should be given some sort of financial support?
See, it will depend on how revenues behave. So the first month, which is the peak of the festive season, revenues did very well. And we exceeded, 2 lakh crore. The second month after the reform, of course, the rate of growth in revenues has been somewhat tepid. So we need to wait and watch. And if we find that there is really, some sort of a dip in revenue, which is beyond expected limits and which is not likely to be made up through, increase in demand or the boost it gives to consumption, then I do acknowledge that, some relief should be provided to state governments, particularly those that face acute, fall in the revenues.
One question on the implementation part. CBIC is still monitoring whether GST benefits are passed on to consumers. What more could be done to ensure effective implementation of GST rate reduction?
I think they're monitoring the situation. And like you said, they've laid out a very elaborate mechanism for field formations to keep watch on prices and to report back instances where, it is found that the benefit has not been passed on. But I think it is only fair to make a point from the point of view of businesses. And there seems to be some lack of clarity, and I'm speaking on the basis of case law and jurisprudence that's already there, that businesses are facing with regard to anti-profiteering provisions in law. I think there is lack of clarity about whether, when there's a drop in the rate on a finished product, let's say a final consumer product, it could be some, item, it could be a food item, it could be anything else. And there is a rate inversion. What happens is typically there is accumulation of input tax credit, which businesses are not able to draw back fully. Now, as long as the inversion and the accumulation is on account of goods, there is already a mechanism to provide refund of the accumulated credit. There's no problem with that. And in fact, the government has taken a very welcome step by announcing a quicker, refund mechanism, which has been put in place. But the fact remains that there is a lot of accumulation in such cases in respect of input services as well as capital goods also. And that accumulation gets, aggravated when the rate of tax on the finished product is much lower than what it is on the inputs. Now, in the present rate structure, as you would be aware, inputs would attract a rate of tax of 18% and the finished product would attract 5%. Now, that's a huge differential. Now, even if the differential is refunded to the business entirely, there is further accumulation on account of services, which are all at 18, and capital goods, which are also at 18, which the businesses are left, with in their books of accounts. So, it is difficult for them then to pass on the benefit entirely to the consumer. Otherwise, they have to absorb this cost on their own. To the extent they can, it's well and good, but it's not always possible. So I think there needs to be clarity about what is meant by passing on the benefit commensurately, which is the word used in law. And it would help all businesses, in keeping good accounts and in complying with this provision well, if, there is some clarification which the council or the government issue on whether it is to be done on gross basis or on net basis. So I think that is one thing that needs to be done further to improve implementation. I don't think businesses are shy of passing on the benefit, but it's just that there is some lack of clarity. And maybe in the short run, they're able to absorb the cost. But if this is a perpetual sort of gap in the rate structure, then they may not be able to absorb the cost on the medium term or long term basis. So that will become a big constraint for them, and it needs to be resolved quickly.
Before I let you go, Mr. Johri, allow me to ask one more question. We have come a long way. According to you, what could be the next set of reforms under GST?
I think one single and major point that needs to be addressed if we really want to move into a pure and much more efficient GST is to remove the bottlenecks that are currently there in the flow of input tax credit. Apart from specific restrictions in law on the availability of input tax credit to businesses, as I mentioned earlier in this discussion, because of inversion in rates of tax within goods, there is a problem of accumulated input tax credit with regard to services and capital goods. And I think the government needs to come up with some solution. Otherwise, in an ideal GST, each business is only an agency through which the tax moves. And eventually, the burden of the tax should fall on the consumer and not on the businesses. If you have bottlenecks in the input tax credit chain, then what it does effectively is to impose costs on businesses. They're not able to pass on or fully neutralize the input tax that they have paid on services, capital goods, etc., which they have acquired for carrying out their businesses. And so it becomes a cost to businesses. Unless they write it off in their books of accounts, they have to keep provisioning for it, and it adversely impacts their working capital availability. So I think this is a major problem that needs to be addressed. I see this as one of the issues which I'm certain the GST Council will take up in the short to medium term in future. The other thing which I think needs to be worked on is, and this is from the point of view of ease of doing business and ease of living. So large businesses that have a pan-national presence, that have registrations across the states or need registrations across the states, you see the business environment is also changing. There is greater emphasis on electronic commerce and quick commerce now. These are businesses that are growing at a phenomenal pace, across the country. They open branches very quickly in different parts of different cities, different parts of the country, etc. Now the registration process for them becomes very arduous. So I think some mechanism needs to be thought of where settled businesses that already have registrations in state A or B or C, if they want to open branches in other states where they don't have presence currently, it should be made much easier. They should be automatic. If need be, the government can follow it up with, verifications post-registration so that they can at least start businesses. Also, for large businesses like, travel agencies, for airlines, for banks, insurance companies, where the volume of transactions is very large, even though they have state-wide registrations, it is extremely cumbersome and difficult for them to deal with audits, which are done on a state level. So I think we need to move into a system, and I think some experiments are already being conducted on this. And the GST Council had approved those quite some time back, and I'm sure pilots are being conducted. I think we need to experiment in a big way with centralized audits and assessments for such businesses, even if we cannot allot them centralized registrations as it used to be under service tax. These are mainly service industries, and it's very difficult and very compliance heavy for them to subject themselves to audit from time to time, in different states, different parts of the country. So I think it will help both from the point of view of the government, because if you do a centralized audit, you are able to get a 360-degree view of the business and how it's being conducted, what are the internal controls across the country, and you'll be able to come up with a more meaningful and more incisive audit. And it will also help businesses because, they will have to deal with compliance at one level and, once and for all. So I think this is an idea which is just waiting to happen, and it should see the light of the day. So these are some of the suggestions. The invoice management system, which has been launched, there are some, difficulties which businesses have pointed out with regard, and some have already been resolved. But I think, some attention needs to be paid on how it can be made easier for businesses to implement that. So these are some suggestions I have, and then I think we'll be, in a near perfect, I wouldn't say perfect, but near perfect kind of GST, which everybody is sort of aspiring for.
The year 2025 delivered a boost to the economy with long-awaited labor reforms. After nearly 5 years, the government has notified the implementation of 4 new labor codes, signaling a major overhaul of the labor market.
The 4 labor codes on wages, industrial relations, social security and occupational safety replace a complex web of over 29 central labor laws. The government says the move will simplify compliance, reduce litigation and create a more flexible and transparent labor ecosystem.
The codes have a big provision for flexibility in terms of flexible hours of working. It has provisions for the gig and platform work, the new digital economy. So in that sense, it is an enabler for Industry 4.0. Along with that, in terms of formalization, in terms of, I would say, universalization of wage security, universalization of occupational safety and health, universalization of social security covering unorganized gig workers, etc. for the first time. It's almost in sync with whatever has been done in the developed world. So it is a big change in that sense.
One of the key highlights of the reforms is the expansion of social security coverage to gig workers, platform workers and those in the unorganized sector, a first of its kind initiative at the national level. The codes also mandate timely payment of wages and strengthen provisions related to provident fund, insurance and gratuity.
Its success lies in effective implementation, and therefore the role of state governments will be very crucial. A pragmatic and competitive labour markets will open the doors to Viksit Bharat by 2047.
States has been continuous. We very recently had a national workshop on 11th and 12th November on various issues, including a discussion on the labour laws. And we will be continuously engaging with the states because, as I said, we are one country and we believe in the spirit of cooperative federalism.
With the notification of the 4 labour codes, India takes a decisive step towards modernizing its labour market. The real test, however, will lie in the effective implementation by states and ensuring that the promised benefits reach workers on the ground.
Year comes to an end, the government's reform express has gathered fresh momentum. These measures are expected to have a long-lasting impact on consumers, industry and the economy.
During the winter session of Parliament, the centre introduced key reform bills and successfully steered them through both houses. One of the most significant legislations cleared by the Parliament is the Sabka Bima Sabki Raksha Bill, also known as the Insurance Laws Amendment Bill 2025. The bill allows up to 100% FDI in the insurance sector.
I rise to move for leave to introduce a bill further to amend the Insurance Act 1938, the Life Insurance Corporation Act 1956, and the Insurance Regulatory and Development Authority Act 1999.
The government believes that the country needs further capital infusion into the insurance sector. This will ensure that we benefit from better technology, world-class risk assessment models, and the best insurance products available anywhere in the world.
But to attract global capital and technical know-how, the FDI limit had to be changed.
In another landmark decision, Parliament approved the Shanti Bill, opening up India's nuclear power sector to private participation. The legislation allows private companies to operate nuclear power plants in the country under a regulated framework, marking a historic shift in India's energy policy.
India's new framework is now aligned with global benchmarks. The new framework clearly defines roles and responsibilities for safety regulation and operations. While the government will oversee licensing of nuclear power projects, the AERB will handle safety authorizations independently.
The move is expected to accelerate capacity addition, attract private capital, and support India's clean energy transition as nuclear power gains prominence in the country's long-term energy mix.
The government is now pushing next-generation reforms to shape the vision of Viksit Bharat by 2047. We saw the early signs of this in 2025. The big question is, will 2026 deliver more big-ticket reforms to build a modern economy? Will the reform measures help India tackle global headwinds? Only time has the answer. Meanwhile, stay tuned and keep watching ET Now.